Hello and welcome to the Comm 217 midterm review. We're going to be solving problem 2 of chapter 6, problems. So we have a receivable and bad debt problem here. So as always, we're going to start with our required and see what we're asked to do. So required A, prepare all necessary journal entries to reflect the information above. So we need to do all of our journal entries for this, for required A. Required B, record the journal entry for bad debt expense for the year ended December 31st, 2016. So next, we're going to have to do the journal entry for the bad debt expense. And require 3, we have to calculate and interpret RMV's receivables turnover ratio. So we're going to get to that after. We're going to start with A and B, and then we'll look at required C. So RMV Corp is in the process of preparing its year-end financial statements. RMV's fiscal year ends on December 31st, and it uses the allowance method to estimate bad debts. RMV has a collection policy where trade receivables should be collected in 45 days, so this could be important, so we're just going to underline it. Based on prior years, RMV usually books 12.5% of its trade receivables as estimated bad debts. So this is going to be very important for required B. We know that our bad debt, our AFDA, should be equal to 12.5% times our accounts receivables. The statement of financial position of RMV Corp at December 31st, 2015 includes a trade receivables balance of $208,100 and an AFDA accounts credit balance of $17,300. So what we're going to do on the next page is we're going to set up T accounts for trade receivables and for AFDA. So we have our trade receivable and we have our AFDA. And as we do our journal entries, we're going to plug it into our T account so that we can know what our ending balance is for both accounts. So for trade receivables, we have a balance of $208,100. So $208,100. And for AFDA, we have a credit balance of $17,300. So $17,300. So let's start going through each of the items that occurred in the year, the transactions, and we'll do the journal entries. So first, trade receivables of $138,000 were collected. This amount includes gross sales of $40,000 on which 2% sales discount were allowed, and the customer took advantage of the discount. So, transaction 1, we received cash. We gave a sales discount, so we're going to debit that as well. And we're going to credit trades receivable. So we had receivables of $138,000 that we collected. So we're going to immediately put that into our trade receivables. And on $40,000 of sales, we gave a 2% discount. So 2% of $40,000 is $800. It's a sales discount of $800. And the balance, the $137,200, was all collected in cash. 2. An additional $6,700 was received in payment of an account that was written off in 2013. So if we've already written off an account and we now are going to collect it after it's been written off, before we actually record collecting it, we have to reverse having written it off. So to reverse it, we're going to have to create trades receivable again. So we're going to debit the receivables and we're going to credit the allowance for doubtful accounts. And this amount was for $6,700. So we're going to plug that into our T accounts. And we're now going to record collecting it. So debit cash, credit trade receivables, $6,700 for each. And finally, transaction 3. Customer accounts of $1,900, were written off during the year. So we're going to write that off now. So we're going to debit allowance for doubtful accounts. And we're going to credit trades receivable for $19,500. So these are our journal entries for the year. And we're now going to sum up our T accounts. So get out your calculators and we're going to calculate this together. So for our trade receivables, we have a debit balance of 50,600 in our account. And for our AFDA, if you add 17,300 plus 6,700 minus 19,500, we have a balance of 4,500 in our accounts, in our AFDA, our allowance for doubtful accounts. Required B asks us to do the journal entry to record the bad debt expense for the year. And if you recall, it is supposed to be 12.5% of our trade receivable balance. So let's do required B. So we know for sure we're going to debit bad debt expense, and we're going to credit AFDA. Now, 12.5% times 50,600 is going to be our desired AFDA. So 12.5% times 50,600 gives us 6,325. However, we already have a balance of 4,500 in our AFDA. So we want to get from 4,500 to 6,325. So to calculate that, we'll just subtract the difference between the two. And that's how much we're going to record a bad debt expense for. So that is 1825. So we're going to debit bad debt expense 1825, credit AFDA by 1825, and that is required B. And finally, let's look at required C. So the year ended December 31st, 2016 had recorded gross sales of $1,080,000, cost of sales of $432,000, and net credit sales of $750,000, cost of sales on those sales in the amount of $300,000. Net earnings were $248,000, and RMV has a tax rate of 18%. Calculate and interpret RMV's receivables turnover ratio and the average days to collect. Based on your calculation and interpretation, give two suggestions to RMV. So, the receivables turnover ratio is equal to net credit sales divided by average net receivables. So, our net credit sales for the year were $750,000. Our average net receivables, well, net receivables is your AR less AFDA. So we just calculated our AFDA for the period. So we know what that is, and we're going to be able to calculate it. So at the beginning of the year, we had receivables of $208,100, and we had AFDA of $17,300. Plus, at the end of the year, we had trade receivables of $50,600 and AFDA of $63,25. So $50,600 minus $63,25, and we're going to divide these both by 2. So our receivables turnover ratio is equal to 6.3809. So it's equal to about 6.38. Now they ask us to collect the average days to collect. So average days to collect, that is equal to 365 days divided by your receivables turnover ratio. So that's 365 divided by 6.38. And so if you calculate that, that'll give you 57.21 days. So on average, RMV collects their receivables every 57.21 days, and they completely cycle through their receivables 6.38 times per year. So how do we interpret this? RMV collects their AR 6.38 times per year for an average of 57.21 days. And so let's just take a look. If you look at the narrative, it says they collect every 45 days. That's their collection policy. 57.21 days is higher than that. So 57.21 is greater than the 45-day collection policy. So let's give them some advice. How can they improve this? Well, one way that they can improve it, so suggestion 1 is find better quality customers to lend to. So better quality customers, and you can do that by, credit checks or credit history. Or suggestion 2, give sales discounts for timely payment. And we'll give a third suggestion, is to do a better job of following up with customers who owe you money. So that's it for question 2, and we hope you join us for problem 3.